Good day, everyone, and welcome to our quarterly series, Navigating Through the Current Market Environment. We'll do a review of the past quarter for both equity and fixed income markets, as well as look forward and talk about inflation and its impact on your investments. My name is Derek Cattell, and I am the head of wealth and sales for Victory Capital. We are a global diversified asset manager managing over $160 billion in assets. We are publicly traded on the NASDAQ exchange, ticker VCTR. We serve clients ranging from sovereign wealth funds and pensions and individual investors, all with access to the same investment options. Want to touch on a couple things that we have done to better serve you is we have built our wealth advisory group to provide our investment services to you as a courtesy to our most valued clients. The group represents over 270 years of combined investment experience, including several CFPs and certified investment management analysts. They are your dedicated wealth advisor and can provide answers about retirement and education planning, trusts, and wealth transfer. Please reach out to them for a portfolio review and for any investment-related questions you might have. Wanted to touch on a few coming attractions we have coming as well. Our mobile app is coming soon on both Apple and Android platforms. You may have also seen in the press, we are launching a crypto asset private fund. We are partnering with NASDAQ as an index provider and Hashtax as an expert in crypto assets to offer an investment in multiple coins in a single investment. So please keep an eye out for both developments. Without any further ado, I'd like to introduce Scott Kefer to discuss the equity markets. Scott is a senior manager for Victory Shares and Solutions and has over 25 years experience as a portfolio manager. Scott, the floor is yours.
Thank you, Derek, and I extend a special thanks to everyone for joining us on today's call. So today I'm going to walk through a little bit about what we're seeing in equity markets, both in the second quarter in particular and through the year to date. I'll tie in a little bit of the macro environment and how we really see it affecting different asset classes. And then lastly, I'll share some thoughts on how we're navigating through the current environment. So I think we can all agree that the global economy has really rebounded significantly off the pandemic lows that we experienced last year. That unprecedented amount of stimulus that was really initially deployed to serve as an important backstop when the economy was shut down has really created massive liquidity that is providing further fuel to an economy as it reopens. And this is leading to shifts in the styles and sectors that are driving equity returns. And it's also impacting interest rates and inflation, both of which Jim and I will discuss during the presentation. So on the slide you see right now, it kind of lays out and depicts a little bit about what I just laid out. Where on the demand side, we really have an incredible amount of pent-up demand as the economy reopens. But we also have what has been unprecedented fiscal and monetary stimulus that we'll look at in just a second that's created massive amounts of liquidity and is contributing to the surge we've seen in consumer net worth and in inflation in terms of asset values. But the surge in demand is running into tight supply chains and lean inventories. And the implications that we're seeing as a result of these two forces is, first and foremost, we're seeing very strong economic growth. In the first quarter, GDP was up over 6%. We'll be getting second quarter GDP shortly, and it's expected to be in excess of that. And we're also seeing very strong corporate earnings coming in. We're probably a little more than halfway through the second quarter earnings season right now, and results are exceeding what have been pretty lofty expectations. When you look at companies in the S&P 500, for example, they're on pace to deliver over 20% year-over-year revenue growth and earnings growth in excess of 65%. And granted, these are off pretty easy year-over-year comparisons when you think about last year's sort of COVID trough. But again, the results are exceeding expectations, and it puts the S&P on pace to deliver full-year earnings that are going to be likely in excess of $220 a share, which further supports the current equity valuations. But the supply and demand conditions that we're seeing, it is creating inflationary pressure, levels we haven't seen in quite some time. And lastly, as I mentioned too, it's put its potential pressure on rates moving forward as well. So on this slide, I'll try to put that stimulus into perspective. Each of these charts go back to 2008, so they kind of capture the trends we've seen in fiscal and monetary response really since the great financial crisis, so not just COVID. So when you start in the top left, you're looking at a chart on M2 or money supply. It's a measure of the year-over-year growth in cash and liquid money market instruments. You can think of it as sort of money on the sidelines. So it provides a little bit of insight into the massive liquidity I referenced and the potential buying power of the consumer and businesses. And while the growth rate peaked in Q1 at just under 30% year-over-year growth, the money supply continues to increase at an impressive 14% year-over-year rate, well in excess of that 5% level we saw between 2008 and 2019. Now, the chart on the bottom left shows the impact of the fiscal stimulus. So here we're looking at the federal deficit, which has increased by nearly $4 trillion in Q1. And has since pulled back a bit as we roll off some of the impact of those stimulus checks, the tax relief packages that policymakers implemented last year. We're also beginning to see a little bit of an increase in tax revenue that's contributing to the deficit reduction. But here too, the deficit spending remains at very elevated levels, and we could still see an infrastructure bill which would provide even further fiscal stimulus. So then moving to the top right, this is QE, or quantitative easing. And this represents the bond purchases in this chart for both the US Federal Reserve's bond purchases and the European Central Bank's program as well. So a little bit of a global perspective on QE. And together, the two central banks have infused over $8 trillion in combined stimulus through these bond purchases. Moving lastly to the chart on the bottom right are global short rates. And this is a reflection of the cost to borrow money. I think we all know rates are extremely low, but I think this chart does provide a good perspective on just how low and how much rates have continued to come down even since the great financial crisis in 08. Again, another source of liquidity that's helping to fuel demand. So when you look at the four charts, it's pretty clear that monetary and fiscal policy have really combined to create a lot of firepower that really didn't only serve as a means of bridging the gap when the economy was shut down last year, but now it's become really further fuel to drive economic growth as the economy is reopening. So if you move to the next slide, we have surging demand, we have a lot of liquidity, but we have tight supply, and this is driving prices higher. So on this slide, we're looking at a chart of the Bloomberg Commodity Index, and it's an index that reflects prices of everything from oil and gas to corn and soy and to gold and silver. And as you can see in this chart, over the last year, this index is up over 42%. And if you look at the next slide, we're seeing clear signs of inflation in the core CPI index as well. So in June, the CPI rose to a 4.5% annual growth rate. Now, to put this into perspective, as you can see this in the chart, the last time the CPI was 4.5% was 1991, so over 30 years ago. And the persistence of inflation at these elevated levels is probably one of the key debates or conversations in the market right now. The Federal Reserve's position has been very clear. They're talking about it probably as we speak, that they believe inflation is going to be transitory. And based on Chairman Powell's previous congressional testimony, transitory likely means for the remainder of this year. And investors appear to share a similar view that inflation is likely going to prove transitory. And it's worth noting that we're already starting to see some signs of inflation easing in certain areas like lumber prices and copper prices. But in other areas, inflation still remains pretty high. When you look at the automobile pricing, rents, wages, inflation is still pretty hot in those areas. And I think the bottom line here is that we should expect there to be continued debate about inflation in the second half of the year. We'll likely continue to hear conversations about how long will inflation remain elevated, whether it might need to be dealt with more quickly by the Fed, and at what level it'll ultimately settle in at. And I think, too, reasonable expectations is that inflation likely continues to surprise a bit on the high side for the next few months, but does ultimately settle down as we approach year end. But I think a reasonable expectation is that it still likely remains slightly elevated, at least since the recent history, as you can see here on the chart. And it's not necessarily a bad thing for stocks. It just might make certain stocks and certain sectors, certain styles potentially more attractive than others, as we'll discuss in just a few minutes. Moving to the next slide, the other key debate in the market right now really surrounds interest rates. This is a chart of the 10-year Treasury, or the yield on the 10-year Treasury. And as you can see, rates peaked at the end of the first quarter at around 1.75%, but they have pulled back since March 31st. We ended Q2 at around 1.45, and today we're sitting around 1.25. And this is really Jim's area of expertise, so I won't spend too much time on this topic, but I will say from an equity investor's perspective, bond yields have been defying conventional wisdom over the last few months. I think normally, given the kind of inflation numbers we're seeing, we would have expected yields to continue to rise a bit, but in the last few months, yields have declined. And what could be contributing to this? Well, it could be for any one of a number of reasons or a combination of reasons. One explanation is that investors are buying treasuries for defensive reasons, that maybe there's fear in the market that the Delta variant of COVID could continue to spread, could lead to another round of shutdowns, which would potentially slow the economy. So investors are moving into the safety of treasuries for that reason. Or some attribute that decline in yields to the Fed's aggressive bond purchase program, that QE that I discussed earlier. That is, the Fed is out there buying billions of dollars of bonds. It pushes prices of bonds higher and then puts downward pressure on yields. And then I would say another explanation is simply that the market now expects that the Fed is going to begin raising rates a bit sooner than they had previously expected, maybe a few months ago, and potentially raise rates a little bit faster than expected as well. And by acting more quickly, maybe the Fed won't need to raise rates quite as much as maybe we thought entering this year. And again, I'm sure Jim will have more on this topic, but for now, let's shift gears and take a look at what all this has meant for asset class returns. So on this slide, we're looking at year-to-date performance of various asset classes. And generally speaking, it largely reflects what one might expect during a period of strong growth and elevated levels of inflation, where commodities, not surprisingly, were the best performing asset class through the end of June. And we also saw small caps were outperforming larger companies. We saw value, which tends to be a little bit more cyclical exposure, outperform growth. And despite the recent pullback in rates, that strong surge in rates we saw to start the year left some of the more longer duration treasuries, the 30-year in particular, as one of the worst performing asset classes in the first half of the year. And if you look at the next slide, you see something similar in terms of the year-to-date sector returns for the S&P 500. They tell a similar story. You see things like energy stocks, for example, leading the way in the first half as WTI surged over 50% in the first half of the year. You see financials performing well as that rising rate environment tends to be favorable for financials. Real estate stocks are benefiting as the economy reopens, rents and asset values continue to increase. So sectors are largely reflecting that same reopening and cyclical trade that we saw through the asset class lens as well. But when you look at second quarter asset class returns on the next slide, it tells a slightly different story than what we saw in the year to date. While commodity stocks continue to lead the way in the second quarter, we did see a sharp rebound in large cap growth stocks. As we saw in the year to date slide, large value is still leading large growth by about 400 basis points year to date. But here you can see in the second quarter, growth stocks outperformed value by over 600 basis points. And this reflects some of the fears in the market around economic growth. Again, going back to that idea that maybe the Delta variant might cause more shutdowns, slow this cyclical recovery that has lifted value stocks over the last 9 months and has swung investors back into some of the more growth-oriented names. We also saw a reversal in the performance of just large cap stocks, generally speaking, outperforming small cap stocks in the second quarter, reversal from what we see in the year-to-date numbers. And then lastly, given the recent pullback we've seen in rates during the second quarter, those longer duration treasuries, again, rebounded, became one of the better performing asset classes with the 30-year treasury up about 5%. So let's shift gears again and discuss some of the important considerations when navigating the current market dynamic. And we'll start by looking at market cap weighted indexes like the S&P 500, which have become incredibly popular in recent years. They serve as an important core position in most investors' portfolio and are there for a good reason. But it's important to recognize that while the S&P is thought to be and thought to provide, I should say, broad equity exposure, cap-weighted indexes like the S&P have become very concentrated in just a handful of stocks and sectors. As this chart shows, concentration in the S&P 500 has reached levels we haven't seen since the 1970s. Back then, the S&P was concentrated in the major oil companies, but today it's concentrated in the mega cap tech companies, where the top 5 holdings are Apple, Microsoft, Amazon, Facebook, and Google. And these 5 companies combine to represent over 20% of the index weight. So given their weight, their performance, I should say, plays a very significant role in the overall return of the index. Now, concentration can be a great tailwind when those names are outperforming, but if they lag, they become a headwind too. So on the next slide, we point out that we've seen these cycles of concentration before, again, where the heaviest weights perform well and really help to drive returns. What you're looking at in this chart, it compares the rolling 1-year return of the largest 10 companies in the S&P to the rolling 1-year return of the other 490 stocks in the index. So when you see a turquoise mountain, it means the top 10 largest stocks are outperforming. And when you see a purple valley, it means the other 490 stocks are outperforming. Higher the mountain, deeper the valley, the greater the outperformance. Now, what you notice is that we've really had 2 cycles of concentration, 2 periods of turquoise mountains. The first occurred in the late 90s. That was during the dot-com era. And the second cycle occurred just over the last 5 years on the right side of this chart. Notably, last year, during this most recent cycle of concentration, it significantly eclipsed the cycle we saw during the 1990s. During this recent period, we saw the top 10 stocks outperform the other 490 by 41%. At the height of the tech bubble, the top 10 stocks outperformance, it peaked at 18.7%. And following the cycle peak in 1999, we then saw a decade-long purple valley where the other 490 stocks outperformed. And this is a period where a more diversified approach with less weight, less exposure to those top 10 holdings, greater exposure to the other 490 would have outperformed an S&P cap-weighted type of an approach. Now, if you take a look at the data point furthest to the right of this chart, that negative 3.5%, it shows just how much we've come off that recent cycle peak. In other words, the bottom 490 stocks are beginning to outperform. And it begs the question, could this be the beginning of another purple valley? Again, if that were to occur, a more diversified approach will likely outperform a cap-weighted approach. So if you look at this next slide, this S&P concentration, and as it has changed, it's also changed in terms of sector concentration of the index. This is a great chart that shows the composition, the weights of the S&P 500 and its exposure to growth sectors versus its exposure to cyclical sectors going all the way back to 1925, where the orange line represents growth and defensive sectors, so technology, communication services, healthcare, consumer discretionary, and the green line represents those cyclical sectors, so financials, industrials, material, and energy. What this chart shows is that growth and defensive sectors, that orange line, now represent 80% of the weight in the S&P. It's an all-time high. And meanwhile, the cyclical sectors, the green line, have been reduced to just 20% of the S&P 500's weight. It's an all-time low. And this greatly exceeds what we saw during the peak of the tech bubble in the late 1990s, when growth sectors reached 70% of the index weight, only to soon after pull back to under 60%. And generally speaking, growth and defensive sectors have outperformed in the last 5 years because there was a bit less certainty over the global economy's growth outlook. And you can point to the aftermath of the great financial crisis, more recently COVID, for creating this uncertainty. And it's reflected in the chart, where you can see those 2 lines, the orange and green lines, really begin to move in opposite directions soon after 2008, soon after the great financial crisis. And then late last year, when the slope of the lines almost become vertical, when COVID shut things down. But now, in the rightmost part of the chart, you're beginning to see these lines hook back towards each other again. And this is because of the cyclical rally that started late last year as the economy began to reopen. And I'm not going to suggest these lines completely converge, but if this rally in cyclicals continues, once again, strategies that offer greater diversification, greater exposure to cyclical sectors or to the green line will potentially outperform. So on the next slide, we'll shift again and look a little bit at US stocks versus non-US equities, international and emerging markets. And I think similar to what we saw in the cycles of concentration chart, here too we see cycles over time. And I apologize, there's a lot of information on this slide, but if you simply look at the four quadrants and you start in the top left, from 1988 to 1993, this was a great time for emerging markets as they meaningfully exceeded the returns of US equities. But this period gave way and was followed by the great dot-com rally in the 1990s that favored the US stocks, which is pictured in the top right. If you move to the bottom left, when the tech bubble burst, it gave way to a decade-long period from 2000 to 2009, which saw both international and emerging market stocks outperform the S&P. And then in the bottom right, over the last decade, US stocks have once again outperformed. So why do we believe we could see another cycle shift? Why do we like non-US stocks right now? Well, because they too are benefiting from stimulus and pent-up demand. But additionally, as we'll look at in a minute, these markets tend to be relatively more attractive from a valuation perspective. And then lastly, we bring it up because we find many investors tend to be underweight non-US equities, both international and emerging market stocks, given their relative underperformance over the last few years. But I think now is a good time to revisit some of these asset classes. So on the next slide, we'll look more closely at this attractive valuation and growth profile, looking at emerging markets in particular and comparing them to US stocks. This chart compares the PE ratio, the valuation, and the earnings growth for the stocks in the MSCI Emerging Market Index to stocks in the MSCI USA Index. And as the chart clearly depicts or shows, emerging market stocks are currently trading at a pretty steep discount to US stocks based on their forward PE ratio. US stocks almost 30 times, and the PE ratio on emerging markets 18.65. And this cheaper valuation is despite the fact that emerging market stocks have both higher expected forward earnings growth and higher trailing earnings growth. And we believe this attractive valuation and growth profile creates a pretty attractive setup for emerging market stocks, again, in particular for investors who are currently underweight the asset class. Moving to the next slide, we've talked about the preference for greater diversification. We've talked about international stocks. Let's just spend a minute on the broader economic cycle and where we believe we sit today. Understanding where we are in the cycle can help us in terms of what equity style exposures tend to perform best during the different phases of the cycle. And what this chart shows are the four phases of the economic cycle listed along the top, from Goldilocks to heating up. Beneath that, it characterizes each of these phases as either being pro-cyclical or defensive. And at the bottom, you can see the equity styles that tend to do best during each of these phases. Now, clearly COVID last year put us in that defensive phase of the cycle for most of last year. And in that defensive type of environment, higher quality stocks, stocks with lower volatility, they tend to do best. And we really remained in that part of the cycle until early October of last year. And that's when the first vaccines got rolled out. And things really began to change and pushed us further to the right. We began to move into more of that heating up part of the cycle. And in this pro-cyclical regime, value stocks, momentum stocks, smaller size companies, they tend to do best. Now, while we continue to be mindful of the potential spread of that Delta variant and its potential impact on growth, we continue to believe that the combination of stimulus and reopening, that pent-up demand, keeps us in that pro-cyclical phase of the economic cycle, where again, value, smaller size should be relative outperformers from a style perspective. So on the last slide, I'll wrap things up, try to summarize a lot of what we spoke about and touch on some of the styles and exposures we're favoring in the current environment. Overall, we do continue to remain constructive towards equities as the reopening of the economy, again, backed by considerable stimulus and liquidity, is supportive of continued economic growth and strong earnings growth. And in this environment, we believe investors should consider strategies that offer greater diversification versus that stock and sector concentration that can occur in a cap-weighted approach. We also believe, because we're in that more pro-cyclical part of the economic cycle, that we prefer strategies that offer greater exposure to value and cyclical stocks. And we also like strategies that focus on dividends. We didn't talk much about this, but not only for the income potential, but also because high dividend strategies tend to have more of a value style tilt. So it fits the point I made earlier about pro-cyclical part of the cycle, value tending to do well. And then lastly, and a good transition to Jim, within fixed income, we favor an active approach with a team like Jim's with their disciplined focus on income. So with that, I'm going to pass the mic to my partner, Jim Jackson, the head of fixed income for USA Investments. Jim?
Thank you, Scott, for that. Just quick introduction, Jim is the head of fixed income portfolio management for USA Investments, where Jim is presiding over 10 of our funds that have a 4 or 5 star Morningstar rating. So with that, Jim Jackson, if you could please take it away.
Thank you. Certainly a pleasure to present today. What I plan to run through, Scott touched on some of it. Basically, I want to review the fixed income returns for the second quarter. Second, I would like to review possibly the most popular topic in the markets right now, and that is inflation. What it is, what's driving it, and what we think about it going forward. And then third, I'd like to finish off with our outlook for the rest of this year. Next slide, please. So fixed income returns during the second quarter were very strong. There's across the board, all asset classes saw solid returns during the second quarter on falling treasury rates and falling credit spreads. This is almost the opposite of what happened in the first quarter, where a pretty persistent rise in treasury yields caused less credit intensive fixed income to underperform. Next slide, please. So just to dive a little bit deeper into what drives fixed income returns, I have this slide here, which on the left shows the change in the treasury yield curve. So this chart represents the yield of treasury bonds at different points along the curve. In the second quarter, every treasury bond 5 years and longer fell in yield. And the longer the bond's tenor, the more it fell. So one component of fixed income returns is the underlying treasury yield. And as treasury yields fall, all else being equal, bond prices go up. However, bonds that are not treasury bonds have an extra component to its yield, which is called the credit spread. And this is the incremental yield above treasury bonds that a bond will earn. And that is very much dependent upon how much credit risk you are taking. So the chart on the right shows the change in the credit spread from the first to the second quarter. The general theme was the more credit risk you were taking, the more that credit spread fell. So falling treasury yields plus falling credit spreads equals lower overall yields and higher bond prices. Next slide, please. So this chart dives a little bit deeper into fixed income returns by looking at the excess returns. And by excess returns, we mean what is the return of that bond above a similar treasury bond. So the chart on the left shows excess returns by credit rating. So the higher quality bonds would be on the left, AA, and the lowest quality bonds would be on the far right, CCC. So during the quarter, as you can see, lower credit quality was highly correlated with stronger excess returns. And this flowed through as well by asset class. So this, which is the chart on the right. So high yield was the strongest performing asset class during the quarter. That is one where the spreads fell the most. And interestingly so, taxable muni bonds were also a strong performer during the quarter. Muni's performance had trailed through 2020. It started to pick up during 2021 as spreads in that asset class fell. So the story for the quarter was very much lower treasury yields, lower credit spreads, and a definite risk on trade in credit markets, as high yield was the strongest performing fixed income asset class. Next slide, please. This slide addresses what is probably prior to the onset of, or the growth of the COVID Delta has been the biggest topic across markets, and that is inflation. So this chart is showing reported consumer price index, which would be represented by the bars, versus market-based inflation expectations, which would be the solid blue line. So basically what we saw at the onset of COVID was a significant drop in CPI. Now, interesting to note, the market-based inflation expectations dropped several months prior to reported CPI going down. So as you can see on the far left side of the chart, you see a fairly fast decline in market-based expectations for CPI. And then a few months later, in March, April, May of 2020, you saw CPI fall. Now, when we entered 2021, there were pretty strong growth expectations. We saw treasury yields starting to rise in the first quarter, and we also saw inflation expectations starting to rise at the same time. Now, reported CPI didn't turn until really the March, April, May prints, where reported inflation was higher than expected during that time period. Interestingly so, we saw the market-based inflation expectations stop increasing and actually come down somewhat. So it is interesting to note that as CPI started to increase, and it was driven by a very small number of prices rising, namely energy prices, airlines, used cars, that once those reports started coming in, that inflation expectations for the market started to go down. And this month, thus far, we've seen them move between a fairly narrow range around 2.5%. Next slide, please. So this slide shows how big of a driver certain industries were to the change in CPI. So the circle on the left, that is the basically March, April 2020, and you see a small number of industries experience a significant price drop. So you may recall that oil went below zero during that time period. Airlines were definitely experiencing a massive decrease in demand, and their prices dropped. Now, as we've come out of this and moved into 2021, obviously people are flying a lot more, moving around a lot more at the same time that supply was taken out of those areas. So we started to see pretty substantial price increases in a very small number of industries. So what are we looking for going forward? I would say that if we started to see those the other pricing across other industries start to rise, that would be an indicator to us that inflation might persist at a higher rate. Also, if we started to see wages go up, that would also be an indicator to us that inflation may be more persistent than the market is currently pricing in. But as Scott said, we don't really think this will be clear to us until sometime late into 2021, or perhaps even longer than that. Next slide, please. So this slide shows and is basically underpins our outlook for the rest of the year. So we expect credit-focused fixed income, where we're taking credit risk to earn incremental income, to be well supported through the rest of 2021. There are a few reasons behind this. First is that there are still substantial economic growth expected for the rest of the year. We're also seeing that earnings estimates are increasing, and that companies are beating those earnings estimates at a historically high rate. So strong economic growth, strong corporate earnings support credit. The Fed also remains very supportive of economic growth. So we think that that we expect them to continue to support the market going through the rest of the year. And then finally, we still live in a low yield world where even though rates in the US are low, they are often lower in other parts of the world. And in a yield-starved world, and in a global market, we are starting to see flows into US fixed income from across the globe. So we think those four reasons support strong fixed income returns for the rest of 2021. Next slide, thanks. So this last slide that I have outlines the expertise of our team in managing fixed income. Our focus is on analyzing every individual bond that we buy and understanding the risks that we're taking. Our goal is to provide incremental income to our shareholders above our peer group and above our benchmarks. And we do this by understanding the credit risk of every single holding that we have. We think our approach, which we followed for many years, has had strong outcomes. As Derek has mentioned, a very strong performance of our funds, where almost all of them have a 4 or 5-star rating. And we think that this broad credit-focused expertise is well suited for the type of market that we're in right now. So that concludes my remarks. We can take some questions. Thank you.
One of the questions that we did have is, I think this is probably more for both of you, is what will trigger a reversal in the Fed's easy money policy?
Scott, I can take that if you don't mind. I think what the Fed has told the market is that it changed its approach to managing inflation expectations. So prior to a year ago, they were expecting to keep inflation at 2% or lower, according to their preferred measure. Within the last year, they've changed their expectation that it's become more vague, but that it would average 2% over some unspecified period of time. And I think what they've communicated to the market is that they think the current inflationary environment is transitory. They are operating as such, and that until they think inflation is going to be persistently higher than the 2% marker that they put out there for a fairly decent period of time, that they will keep rates low. Now, I would remind you that the Fed's mandate is not just to maintain stable prices, but they have an employment mandate as well. And their expectation is to, if you allow CPI to, or for them it would be the PCE, to average 2% that would mean it would run a little bit hotter than that for some period of time and a little bit lower than that for some period of time, that would have a better employment outcome than their previous policy of not letting or not wanting PCE to be higher than 2%.
The only thing I would add to that, and Jim, feel free to weigh in on this part of the conversation as well, has to do with the tapering on the QE side, that bond purchase program, which, you know, in all fairness, the chairman is giving a presentation as we speak right now, giving his latest updates on this. But based on the last conversation, the process to begin tapering those bond purchases is expected by year end, which would be one form of starting that process of phasing out some of the easy money. We also saw after the last meeting that I think to tie in some of what Jim was just speaking on in terms of rates, the expectation now is that we'll see some rate hikes potentially next year. But I agree with Jim. I think that it's unlikely the Fed is going to overreact to hot inflation numbers over the remainder of this year. I would not expect a meaningful change in stance until we get through what is being understood to be sort of transitory elevated levels of inflation as things reopen and supply chains ease and inventory levels get put back up to more normal levels. So I would agree with Jim. I don't think we'll expect much in terms of a change in stance towards rates until we watch what happens over the next 6 months or so.
Gotcha. Thank you both. One additional question kind of to both of you is, given the length of time that it's been since we've experienced a significant and prolonged correction in the markets, I guess it's a two-part question is, are you managing money any differently today than say before the pandemic last year or even the financial crisis in 08 or 09? And then the follow-up is, does it concern you that it's been really 12 years since we've had a significant bear market?
I can start on that one. I guess my first point would be that we don't make anything that I even discussed during my presentation about things that we favor right now are not market timing decisions. It's not an all or nothing. We're not saying, when I was talking about concentration, for example, to sell your cap weighted S&P. No, what I'm saying is we lean in and we might prefer, and if we were putting new money to work, we would consider diversification, non-US, et cetera. We're not market timers. We, on our side, and I would think Jim agrees, we're building portfolios, we're building asset allocation solutions with long-term in mind. As it relates to the current conditions, listen, I don't want to oversimplify this, but these types of bull markets come to an end when either earnings peak, which we believe we're a long way from, again, given the kind of reopening we're seeing right now and the health of corporate earnings right now, or we see the Fed be too aggressive and cut that growth off. And with the Fed not expecting to raise rates for at least another year, we don't see that as a catalyst for an end of this. I mean, we are in a very unusual, sustained, lengthy period of great conditions with, you know, a recovering cyclical recovery backed by a lot of liquidity, very low interest rates, et cetera, that are helping to fuel this, that we think can continue as we look out. So we're not, you know, chasing all parts of the market right now. We are maintaining our long-term discipline around diversification, and we're really not going to try to time the market. But everything that we design, everything that we implement is far more geared around long-term asset allocation decisions rather than trying to time short-term tactical moves in the market.
Yes, from the fixed income side, our basic approach and philosophy has not changed during that time period. Just to give you some insight into what we do and how we do it. When we are looking at bonds to put in the portfolio, we have a team of analysts that evaluates the credit quality of that bond. For example, how much cash flow do they generate, how much debt they have, trying to assess the probability of our bonds being paid back, which is obviously the base expectation is that all of our bonds are paid back, but we invest a lot of resources into evaluating the credit fundamentals of any bond that we buy to ensure that any incremental risk we're taking, we're being paid to take it. So that has not changed. I would never expect that part of what we do to change. Things that have been improved over the last 10 or 15 years have been things that have improved across all of our peers as well. And that is how we can measure and manage risk, the increased use of IT and data to perform our job. Those things haven't changed and really have enhanced the process that has been in place for decades.
Thank you both. And I think with that, that actually gives us a good place to wrap it up. Please keep an eye out for the coming attractions that we touched on earlier, which would be the mobile app as well as the crypto asset fund. So thank you very much, and we will see you next time. Thank you.